Hi guys and welcome back to the Mindful Investing channel. Today I want to talk with you about Google stock, ticker GOOG. As always, we will value Google using our simple discounted cash flow model. To be able to value Google using this simple DCF, we have to first make a couple of assumptions. First, we have to assume Google's free cash flow growth rates for the next 5 years and for the 5 years following those 5 years. We also have to assume Google's price to free cash flow multiple at the end of our 10-year holding period. Last, we have to assume Google's annual buyback yield over our holding period. So let's begin with our assumptions for Google's free cash flow growth rates. Personally, I like to base my free cash flow growth rate assumptions on the historical growth rates of Google's free cash flow. When we calculate Google's free cash flow growth rate based on the last 5 years, we come up with an annual free cash flow growth rate of around 21%. Because it gets harder to grow free cash flow the bigger the company gets, and to be conservative, I only assumed a free cash flow growth rate for the next 5 years of annual 15% and for the 5 years following those 5 years of 12%. Next, we have to assume Google's price to free cash flow multiple at the end of our holding period, so basically in 10 years. Because Google is one of the highest quality companies in the world, maybe even the highest quality company in the world, I assumed a price to free cash flow multiple of 20, which also reflects the assumed growth rate for Google's free cash flows of 12%. Next, we have to assume Google's buyback yield over our holding period. Like with our growth rate assumptions, I like to base my buyback yield assumptions on Google's historical buyback yield. When we calculate Google's annual buyback yield based on the last 5 years, we come up with a buyback yield of around 0.7% per year. To be conservative, I only assume the buyback yield of 0.5%. Always remember that it's better to be surprised to the upside. Because we assumed Google's free cash flows to the whole company, which is nominally funded by debt and equity, which bear different costs, we have to calculate a weighted average cost of capital to reflect our cost of equity and the cost of debt. To do so, in our simplified DCF, we simply enter Google's current market cap, its interest-bearing debt, and its interest expenses. Now we can finally calculate our expected annual return based on our assumptions. To do so, we adjust our cost of equity, which is basically our internal rate of return over our holding period, until the number in the green box is equal to Google's current enterprise value per share. When we do so, we come up with a cost of equity, so basically our internal rate of return over our holding period, of 17.1%. So Google currently seems like quite an interesting investment based on our assumptions. That's it for today's video regarding Google. Please feel free to ask any questions in the comments, and if you enjoyed the video, don't mind leaving a like. Please always do your own research, your own due diligence, and never simply trust a guy on the internet telling you that there might be a potential investment opportunity. See you next time.